Welcome to the Turnaround Podcast with your host, Stephen Phillips. In each episode, Stephen speaks to experienced practitioners who discuss their careers, key moments, challenges, and lessons learned in financial turnarounds and business restructuring. Join us as we unravel the secrets to turning struggling businesses into success stories. You can find this show on all the major platforms, including YouTube, LinkedIn, Facebook, Apple Podcasts, Spotify, and on our website, frylibertas.com. Now, here's the host of the Turnaround Podcast, Stephen Phillips.
Welcome to the Turnaround Podcast. As discussed in the very first episode with Andrew Wilkinson, high-yield bonds feature heavily in the distressed debt universe, given they tend to be liquid and are issued by non-investment grade companies. Last episode featured Wolfgang Phillips, an expert in credit analysis of high yield, and I wanted to continue with the high yield theme and discuss covenant structures. I've invited a cracking guest to help us navigate high yield covenants. Sabrina Fox has been analysing high yield covenants for nearly 2 decades, first as legal counsel to prospective issuers, and then as a covenant analyst and trainer. She is the CEO of the European Leveraged Finance Association and the founder of Fox Legal Training, and I'm sure we'll talk about that in a bit. Sabrina's expertise is in demystifying covenants in high-yield bonds, which can often seem opaque and difficult to understand, given they are written often in dense legalese. Sabrina, thank you so much for joining us.
Thank you so much for having me.
Welcome. Well, that's great, Sabrina. I always ask my guests this as the starting question, which is, how did you get to be sitting where you are now? And can you just take us through your legal career?
Absolutely. So I think the one aspect of continuity in my legal career is probably covenants, which is apt that we're speaking about them today. I started out at Skadden Arps in Los Angeles as a young lawyer, and the first assignment that I was given was to prepare a comp chart between different deals. We were doing a deal for a gaming company, and I was basically told to circle the numbers and put them in a table. And that's how easy covenant analysis used to be, believe it or not. I decided that doing diligence in the United States was not as fun as in Europe. So I very quickly moved myself over to London. I was with Norton Rose and then Paul Weiss. And then I felt a sort of call to the entrepreneurial spirit and decided to branch out into something slightly different than the law firm world, following my love for covenants to Debt Explained, where I created the market maker database that basically full circle saved associates worldwide from having to do what I did in quite the way that I did it, by allowing a quick comparison of deals across terms. And then I went very briefly to DLA Piper in between Debt Explained and then was at Covenant Review, where I opened their London office. Again, deep dives into covenants, but from a slightly different perspective and very much with the lender at heart, I think, within that business. And during that time, made some very close relationships with the buy side and felt the call again to something new, which ended up becoming the European Leveraged Finance Association, which I founded with a group of high yield investors in January 2019. I still lead that organization as CEO. We have now 62 member firms, over 1,000 individual members, lots of great work happening there. And then in 2022, again, the entrepreneurial bug bit me and I started Fox Legal Training, which is really designed to demystify covenants, as you mentioned. And it allows me to exercise my passion for teaching, which is something that I did when I was in law school and rediscovered my love for it after I left Covenant Review. So it's been a wild and crazy road to get to where I am now, but I'm lucky enough to be able to say that I do things I love from basically the very beginning of the day to the very end of the day, probably 7 days a week.
Well, I've linked both your Fox website, Fox Legal Training, and the European Leverage Finance Association website on my useful links for those people who are interested. And I guess just going to talk about the association, what's the purpose? Is it effectively to act as a sort of body, a buyer's trade body? Is that effectively what it is?
Yeah, and in a nutshell, and just to be clear, the two businesses are completely separate and run independently of each other. The mission for Alpha is to create conditions in the market so that our members can do their job in the very best way possible, which means efficiency, transparency, better disclosure, more engagement. Any issue that the buy side is grappling with, they can bring it to us to help them carry it forward. We have 8 committees. Across those 8 committees, we're probably working on, 25 to 30 different initiatives at any one given time. So across 4 asset classes: high yield bonds, leveraged loans, private debt, and CLOs, which is phenomenal, actually, given how interconnected those asset classes are now. The leveraged finance universe is really kind of a multiverse now. And we represent the buy side for all of them. So I think that gives us a real advantage in being able to see the kind of, problem from beginning to end and try to kind of link people together to solve it. Yeah.
And I guess what we have seen is a trend since the advent of the high yield bond that the structure has kind of moved across the Atlantic and actually into leverage finance loans as well. Is that what you've seen?
Yeah, absolutely. I mean, it's just incredible how much the structure has changed. And it really does show how versatile the instrument is, which is great for borrowers and investors alike. It's still, there are lots of things which are very much the same, as even compared to loans, but then equally there are lots of ways that they've kind of intermeshed and they share features now. So bonds didn't used to be secured, for example. They were unsecured and subordinated instruments in the capital structure. But when the GFC happened and the loan market was closed, they came in to kind of boost financing for businesses and to help carry the market through. And as a result, emerged in a senior secured place. So that's one of the main changes. But, a lot is still the same as it used to be in terms of structure. It's just that the provisions are more borrower friendly than they once were in the baby lawyer days. It's like,
well, let me just, I wanted to delve a little bit into the history, really to sort of set the scene of what we're going to be talking about. So these bonds used to be called, of course, junk bonds, issued by companies that are non-investment grade, and they became pretty famous as a result of the work of Michael Milken at Drexel Burnham Lambert. And the market for bonds absolutely exploded during the 1980s takeover boom. So very kind of heady mix of leverage finance, this new sort of bond market. And there's a brilliant book, I don't know if you've read it, Sabrina, called Barbarians at the Gates. And it really brilliantly captures the kind of 1980s world of takeover finance, where KKR took over RJR and Nabisco. So that's well worth a read.
Absolutely.
I mean, I think, unfortunately, Drexel and to an extent Michael Milken, completely imploded. But that market didn't go away. I mean, once it had been invented, it was useful. They had to rebrand it. They called it high yield. And as I talked about with Andrew in the first episode, by the sort of late 1990s, early 2000s, it's like these bonds had moved across the Atlantic, and they were really focused on telecoms and electricity firms at that time. And then I came back actually from Asia into London in 2002, and that coincided with, I think, about 88% of European high yield bonds defaulting. So I hope it wasn't it was a coincidence, hopefully. But I think in recent years, it's fair to say that the market has sort of shrunk to an extent. I was reading maybe 200 billion less issuance in the last few years, but I think speaking to colleagues, etc., it does seem like it's sort of really come back. Refinancing's happening. So I don't think this market is anyway going to go away. And I just wanted to feature a couple of, key features of the bonds. So obviously the first thing is they're high yield. So that means a high interest rate. Now, during the say again, Sabrina?
Theoretically, yeah. I think there are
Yes.
some fund managers who might disagree with you over the last few years.
Well, I think over the last few years, the joke was it was the market formerly known as high yield. But
Exactly.
I think in normal interest rate environments, it tends to be quite high yield, fixed rate. New York law governed. So it's important to say we're not talking about, there are other high yield markets, so Norwegian bonds, for example. This is a New York law conversation that we're really having. They tend, they're not listed in the States, or registered in the States, I should say. They tend to be listed somewhere else, like in Luxembourg. The types of investors that you have are generally kind of institutions, but not necessarily banks, and certain individuals as well. And as you say, they're secured. They're in a trustee structure. They tend to have a high percentage to change the money terms. And importantly, they tend to be sort of subject to the intercreditor arrangements, which are really important during a kind of restructuring phase. But we don't have time to talk about that, because we're going to talk about the covenant structures. So I've talked enough. I wanted to sort of get your input now, Sabrina. Can you tell me a little bit more about just the overall kind of structure? For example, the sort of redemption arrangements.
Yeah, absolutely. So, in contrast to a loan, which when I'm teaching for FLT, a lot of our students look at both. So I like to make this distinction. And, they are, there is a non-call period, a period of time when investors are guaranteed to get their coupon. And that's a very important part of the economics for a typical bond. Now, I mentioned before that things have become more borrower friendly, and this is no exception. They used to be non-call 5. I mean, you'd be very hard pressed to find a non-call period that long now. And there are lots of exceptions to the non-call period for things like equity offerings, clawing back some of the bonds to, rejig the balance sheet, but also things like, redeeming 10% of the bonds at 103, which just, it's a handy feature for a borrower who wants to delever a bit at a cheap price. So that's another aspect. And then they are always incurrence covenants. They have always been incurrence covenants. So what that means, in contrast to a maintenance covenant, is that you don't have to do anything unless, to kind of calculate things, unless you do something. So if you need to test the covenants under the old style leveraged loan, you'd probably be doing a maintenance covenant, kind of a quarterly check-in on ratios of various descriptions. But that's never been the case in a high yield bond, which is useful for the borrower because they can kind of set it and forget it. They obviously need to comply with their reporting covenant, but apart from that, it's not requiring them to do anything under the actual covenants themselves unless they want to incur debt or pay a dividend, for example.
I mean, as a restructuring lawyer, there's an interesting point to note here. Well, the first thing is that often high yield bonds are issued in conjunction with other types of debt, like revolving credit facilities or second lien or other things like that. So actually, even though the high yield bonds don't have maintenance covenants, there are other covenants in a way that you're getting an indirect protection from, so that if there's a trigger in the senior, at least that starts perhaps some kind of conversation around a restructuring.
Well, yeah, so, I mean, these days you have to be really careful about that assumption, though, because maintenance covenants have all but disappeared from leveraged loans as well. They appear in the RCF as a springing covenant, but that hardly ever gets tested So there are lots of ways to kind of get around testing it, toward the end of the quarter. And of course, as I'm sure you fellow lawyer know, you could never advise a client to rely on provisions of a contract that they are not themselves a party to. So I agree. Sometimes there is a kind of level setting. There's you come up a little higher in terms of protections because you're sitting in a capital structure with a more protected instrument, but it's not something you should rely on, because if you haven't signed the agreement, those other guys who did can agree to waive those requirements, and then you would find yourself of course, the only requirements you can rely on are the ones in your own document.
And I think, Sabrina, your main point here is actually the disappearance or the sort of reduction in bite, as it were, of loans and the covenants there. So that's a trend I presume you've seen sort of is year on year. It's just sort of in some ways been getting worse.
Yeah, absolutely. I mean, I remember working a covenant review with Jane Gray, and we would kind of compare notes with each other about the deterioration of terms in each of our respective instruments, because she was looking at loans and I was looking at bonds at the time. And then we would start to see provisions you would typically see in a bond ending up in a loan, and then the provisions in a loan ending up in a bond. So, the things that really characterize a high yield bond versus a loan are things like I mentioned, the non-call period, redemption mechanics, the incurrence covenants, but obviously now loans kind of have that too. But loans are, subject to transfer restrictions. For example, they're floating rate rather than, many bonds are fixed rates. So you don't have as many mechanics around interest rates and, most favorization and things like that. And bonds are publicly traded. As you said, they are listed most of the time these days on the Channel Islands Stock Exchange, I think the International Stock Exchange, also sometimes Luxembourg and Ireland. So with the exception of things like net short lender provisions, which do restrict the trading of bonds to certain investors, they are freely tradable, whereas the loans are subject to transfer restrictions, which can go into the pages and pages, and you've got to find the lender on the white list in the in Europe, and blacklist you can't trade to in the US. So those aspects are really quite different, but near enough everything else has pretty much merged into this kind of best of both worlds for the borrower sort of approach to covenants.
Yes. I mean, I said the words it's getting worse, but obviously if you're from a portfolio company point of view, it's getting better. But there's a point probably where the market sort of ceases to make much sense, because the protections have sort of been eroded. Now, I'd like to talk a little bit about the protections. I like your phrase when we were doing the preparation. You talked about value in a box. Maybe you can just talk to what you mean by that.
Yeah, absolutely. So one of the purposes of covenants is to maintain the value in the quote unquote box, which is where the investor has lent the money into, right? So any entity that's inside the box, including their assets, that is effectively under the control of the covenant package. So it's protected. There's a whole range of covenants, the restricted payments covenant and a bond, and then it's dealt with in 3 different places in a loan, because we lawyers like to keep things interesting, that restrict the ability of the borrower to transfer value outside of the box. And I always think of it like this: value going up and value going down. So the value going up, the structure would be dividends, share buybacks. Value going down would be things like repayments of subordinated debt and investments in unrestricted subsidiaries. And those are all dealt with by the restricted payments covenant. And then there's another covenant called the asset sales covenant, which typically restricts it doesn't restrict the ability of the borrower to sell assets, but it puts conditions on their ability. So if they do sell an asset, they have to get a particular type of consideration, and they have to apply the proceeds in a particular way. And one of the interesting sort of permutations of covenants, if you will, that we've seen over the last decade is the intermingling of these two provisions. So the restricted payments covenant and the asset sale covenant, now they're taught together in my course, and for very good reason. It used to be they dealt with very different things. If you told me in my baby lawyer days I'd be one day teaching them together, I would have said that you were crazy. But now the asset sales covenant often can feed capacity for the borrower to make restricted payments, as they're called, which is extending any of that, value outside of the box, which is just something that I never would have thought would happen.
Mm-hmm. Yeah. So just take me through, like, is there a test if a borrower wants to make a dividend payment or pay a subordinated loan? What prevents them or doesn't prevent them?
So the restricted payments covenant will basically say, and either one of those would be a restricted payment. It will say, thou shalt not do that unless you have this capacity. And capacity is broken up in more or less two chunks. So the top one would be the builder basket. The builder basket is designed to accumulate capacity over time. So on day one, there will be more or less no capacity in there at all. And as a result, you also have these permitted payment carve-outs, which are kind of the second chunk of capacity, if you will. And the permitted payment carve-outs will be for specific things, sometimes like share buybacks in relation to management, share plans and agreements and things like that, or dividends following a public offering if the borrower is listed or is selling its already listed shares. And then it will have a general basket or a series of general baskets these days that they can use for any purpose, so any dividend or investment. And then there's a whole separate, again, loving to keep things interesting, there's a definition in the definition section all the way in the back of the document called permitted investments. And that's for things, like I was saying before, that go down, if you will. Though you can use permitted payments for the investments in unrestricted subsidiaries as well, which is something that people tend to forget. But you can use them together with these permitted investments that are for things like that, or investments in joint ventures, or similar sorts of things going down out of the box. Now, that builder basket formulation comes in a couple of different ways. It's either 50% of consolidated net income, deducting, you would hope, 100% of losses. And the thinking behind that is, fine, we're going to protect value in the box. But if the borrower is quite profitable and is, making cash profits, we will actually let them take 50% of that off the table, if you will, to use for things like dividends. Or investments in unrestricted subs, but the other 50% has to stay in the box. And if that accumulation is reduced because they have losses, well, you've got to take those losses one for one. It's not, kind of half of losses. But over the years, while the 50% CNI formulation has stayed more or less the same, whether you have to deduct losses is an aspect of that basket that has changed a lot. So in some deals, they've created this whole kind of alternate universe, la la land, where you don't make losses at all ever. Or you can only deduct the losses until the basket gets to zero, but there are no negative numbers in this la la land. So you don't ever go below zero. And as soon as you start kicking off positive CNI again, the basket begins to build. In the baby lawyer days, borrowers had to take responsibility for all of their losses in this basket. And you might have negative something, big number, that you'd have to claw back to get to the point that you could use the basket again. And then the final point I'll make on this one is that because that 50% CNI basket, or the other formulation is 100% of EBITDA less a multiple of interest expense, because it tends to become the largest source of capacity over time, it is subject to conditions. So if you want to use that, you have to prove basically that you're financially healthy. And what that means, how that is tested, is no default or event of default at the time you want to make the payment. And you can meet your fixed charge coverage ratio, which is more or less a proxy for the financial health of the borrower. Now, again, 10 years of steady erosion in these protections, and this one in particular is died a death by 1,000 cuts, because it's no longer default and event of default, the block. It's just event of default, or in some deals, just material events of default, which are like the bad things, like missing a coupon payment. And the fixed charge coverage ratio condition is often not applied at all for things like investments in unrestricted subsidiaries. So the times have changed quite a lot. And I would say now it's easier to get value out of that box than it ever has been before.
And just the ratio, what are we talking here? The ratio of earnings to the amount.
Oh, sorry. For the 50% CNI is basic. It's not your kind of balance sheet CNI. It's a completely different formulation, which is trying to get to a cash figure. The ratio that I'm referring to is fixed charges. So, tends to be cash interest expense as a ratio to EBITDA. So EBITDA to fixed charges. And they want that to be at least 2 times, because you want to have enough profitability to meet your interest payments.
Got it. Yeah. So let's talk a little bit about moving assets from the restricted group outside the restricted group. So, in other words, the sort of covenants tend to bite on the restricted group, but they don't really bite on the unrestricted group. And presumably the unrestricted group is just not part of the credit support of the entire structure. So
on day one, you kind of wouldn't even expect there to be any unrestricted subsidiaries at all. You want the borrower group to be everything the borrower owns, unless there's a really important reason that it shouldn't be. So maybe there are operations in a country or some jurisdiction where it's difficult to monitor covenants or something. There are the regulatory reasons. Like, it's very rare, but after day one, then there might be capacity to do things like designating unrestricted subsidiaries, which can give the borrower flexibility to do all sorts of things that we can go into more detail about if you'd like.
Yeah. But how do you just how does the designation work? I mean, that can you just sort of generally, right, I'm going to designate this an unrestricted, or what
that's a good question. So you have to have the sort of capacity in the amount which would be considered fair market value for the assets that you want to move out. So the first thing you do is create a subsidiary designated as unrestricted. Now, there are restrictions about the types of relationship that the unrestricted subsidiary can have with the restricted group, because you do want them to be more or less remote from each other. So you don't want overlapping guarantees or investments or liens and things like that. And those restrictions can differ from deal to deal, but they more or less want to keep it ring fenced. And then once you've got that entity there, you can transfer the value in. So you transfer the assets, it's IP, or it can be hard assets, whatever you want, as long as you have the fair market value and capacity to do that. And then once the assets are there, they're released from the collateral package. And that is not a new thing. That has always been the mechanic. As long as you did it in compliance with the covenants, then the collateral is automatically released. Then you can do what you want. So that entity could itself then decide to borrow money at that level, and then send the money back into the restricted group if they wanted to, or that entity could be spun off to equity. That's also an option. So there's literally no restriction at that point on what can happen to the assets there. Now, there is kind of legal nuance here about the spin-off point, that there may be provisions in the restricted payments covenant that will prohibit that. But in many deals that are sort of top tier sponsor style, that would also be permitted.
Got it. Yeah. I mean, I think we discussed very briefly when we were preparing this that there are, of course, laws in various different jurisdictions, directors' duties type laws and insolvency laws that would stop people sort of sending assets away from a company if it's in financial distress, etc. But I think the reality is that investors don't really rely on those sort of rather general duties. They rely on covenants. But what you're really saying is, and I think we'll come to an example in a bit about what happens if those covenants have been a bit eroded. But I also wanted to ask you about additional debt incurrence, priming, and subordination. So maybe we could get into that. How do you raise additional debt, or what do the covenants say about additional debt?
So obviously the covenants have a lot to say about bringing more debt into what would already be a pretty highly levered structure. But there's more ability to do that now than there ever has been. And the way it typically works is that you have a debt covenant, and the debt covenant is also similarly kind of split into 2 chunks. One is the ratio debt basket, and then you've got permitted debt baskets that sit below that are carve-outs you can use for various things. The ratio debt basket in high yield bond is typically measured on a fixed charge coverage ratio. It's typically 2 times, but sometimes it can be ratio. Yeah, exactly. And then the baskets themselves are either special purpose. So, you'll have a credit facilities basket. It's always the first clause. There will be a purchase money, CLO basket. There will be a basket for local lines of credit, basket for, now there are lots of new ways of incurring debt. There's a basket for incurring debt based on contributions of equity. So the borrower can raise either 1-to-1 or 2-to-1 debt to equity that's injected. And then there's another basket, which I could consider more or less new, like in the modern days since 2015 onward, that allows borrowers to convert dividend capacity under the restricted payments covenant into debt capacity under the debt covenant. And sometimes that can also be at 2 times. So, that's one of the things I tend to suggest lenders push back on. And then after you kind of see those elements of capacity, there's then a whole range of provisions that talk about how calculations are made. So there's a concept called reclassification, for example, that will allow the borrower to pretend it incurred debt under the ratio debt basket at any time it has capacity there, because it will always incur the ratio debt first. So if they incurred ratio debt, filled the basket, and then they had, used some carve out, say they used the general debt basket, then if they can meet their ratio, the general debt basket is just automatically reclassified to the ratio debt basket. And then that becomes a free basket again. So those provisions come next. And when I think about the debt covenant in terms of subordination, I think of structural subordination, which is where you get non-guarantors in the structure incurring debt. And the reason that's an issue for the existing lenders in the group is that if there's a subsidiary which has not given you a guarantee, that means they do not have a debt claim to you. You only have a claim through the equity of some subsidiary going down the chain. So if a debt claim arises there with a third party, that third party is senior to you with respect to the assets of that subsidiary, because debt ranks junior to or ranks ahead of equity. So when I'm looking at the debt covenant, I'm not just thinking how much can the borrower incur, but which entities within the borrower structure can incur the debt. And then obviously there are whole provisions around securing the debt. So once you've incurred it, maybe you want to secure it, you want to provide a lien to the lender. So the liens covenant will have some restrictions around that and will basically require that the borrower is able to access capacity in the permitted collateral liens definition or the permitted liens definition. That's how that's typically formulated in Europe. And as you can imagine, permitted collateral liens are liens on the collateral, and permitted liens are liens that are on non-collateral assets. And that's how that formulation typically works.
Right. So let's talk about priming subordination. So I guess just for those people who don't know subordination, I mean, there are 2 types: subordinations, either contractual, which is what we're probably mainly talking about, or it's sort of structural. So it's like, where is that claim within the structure? So what have you been seeing in terms of the ability to prime? And I suppose, we should talk about what priming means, which just means putting a claim higher up, more senior, as it were, to the claim, that the lender has, or the bondholder has. So
exactly.
Take us through this.
Yeah. So in the course that I teach on leverage finance covenants, we talk about subordination in 4 different forms. So we chop it up a little bit more.
Okay, you've got 4. I had 2, but carry on.
Yeah, it's nuance. It's nuance at the end of the day. But we have structural, which I mentioned already. So, I would think of this, I think, just to bring it to light for listeners. Let's think that there's a borrower out there that needs to bring in more cash to the group because they're struggling with liquidity. Well, if you're a struggling borrower, you're not going to just be able to bring in cash at any level, right? You need to borrow at a priority place in the capital structure, or else you're not going to get any lender throwing good money after bad. So there are a number of different ways that you can do that. I think if we think those 4 ways, the first is have a non-guarantor incur the debt, because that's structurally senior. And then you would look at that debt covenant to see how much, capacity you had to do that. But you'd also have to think about how many entities within the group already guarantee the existing debt. Because if you're like Asda and you have 98% guarantor coverage, probably not going to be able to entice a new lender in for that last 2% of revenue or whatever. So it's those two things you have to think about there. And then the next type of subordination would arise in the permitted liens definition, so effective subordination. And that's when another lender has a claim over an asset that you don't have a claim over. So we're outside of the collateral pool and we're looking at this borrower who's struggling to bring in more cash, and maybe they're like an Aston Martin and they've got some nice cars and they've got a racing center, and maybe those are not encumbered with the existing lenders. So you can say, well, I'll give you a lien over this really nice luxury car and then I can bring in more cash that way. So that's effective subordination, because the existing borrower group is subordinated to the extent of the value of the assets that are secured in favor of those other lenders, which means that lenders should really focus on what the company has basically unencumbered, because that could be potential for them to bring in third-party lenders. Whereas to the existing lender group, that represents residual value that they could potentially get in a recovery if it wasn't pledged in favor of other lenders. And then you've got contractual subordination. And for that, I would look at the permitted collateral liens definition, because what that one's telling me is that there's a lender out there who's got, quote, super senior priority to enforcement proceeds. That's one way that contractual subordination can arise. So here I'm thinking borrowers who have a credit facilities debt basket typically can have what I call, sort of term of art, super senior capacity. So a preferential treatment in the enforcement waterfall. And then they can get a security over the collateral, but they've got effectively better security because they're going to get paid first. And these super senior kind of swaths in the capital structure tended to be for the RCF, because the RCF always wants to have a really nice position in the capital structure. But as debt baskets got bigger and the credit facilities basket does not only get to be used only for credit facilities, it can be used for public securities, bonds as well, then that came to be seen as another potential way to bring in a lender at a preferential place in the capital structure. And then the fourth way I think about subordination is temporal. So debt that matures in time ahead of the other debt in the capital structure. And that's not really going to help you so much in a situation where the borrower is distressed, but it's another thing lenders should be thinking about when they're looking at the deal, to think, well, okay, is it possible that I could get primed by virtue of a lender coming in to get, is coming in and going out before my deal matures.
Yeah, and I guess that's often where in an intercreditor agreement, if there's a loan, often the senior debt may well have a right to sort of issue a stop notice or something to prevent, I suppose, temporal subordination. It's a nice phrase, so that you're not having a situation where you're paying out junior debt before the senior debt. So that's and I guess final point on this is priming in a way, bringing it all together is just, I guess what you're saying is there's often lots of capacity and lots of ways of just finding a way of putting debt in a more senior position above the high yield bond. And I guess are we seeing quite a lot of that, do you think?
I mean, there's definitely more of it happening. And it provides the opportunity for things like creditor on creditor violence, if you will, which has happened in the US, I think has yet to really come over to Europe. But I would say, lots of other things that have happened in the US have come over. And I think there is an existing, situation where there is a lender who's looking to kind of potentially advantage themselves ahead of other lenders, which is tricky as a lender, because you're not just thinking about what the company can do anymore, what the private equity sponsor might do. You have to think about what the other lenders in the capital structure might seek to do as well. And with the rise of private debt or private credit, as an industry, there's a lot of capital out there that's looking for a home. So it's definitely something that that lenders should keep in mind.
And I wanted to, we're sort of nearing the end, so but I wanted to talk about some kind of current flashpoints, and I guess this came to the notice of or the importance of covenants, as it were, came to the notice of the market when J. Crew started doing some funky things. Maybe you could tell me about what this J. Crew trapdoor, I think I'd heard it described as, and maybe we'll talk about a current situation that has a certain echo.
Yeah, absolutely. So I would say just to give credit to an older situation, probably Caesars was the first one that really brought people into thinking about. I've got my book back there on that situation. But J. Crew really put the spotlight on unrestricted subsidiaries, because before J. Crew moved assets to an unrestricted sub, borrowed against that, which is effectively another way of getting primed. I don't think that anyone really thought about unrestricted subsidiaries being used that way. When I was a baby lawyer, unrestricted subsidiaries, they were fun money, right? It was something you gave the borrower a flexibility to give them the chance to try out a new line of business or a new jurisdiction where it might be difficult to kind of pay attention to what the covenants, how it would affect the covenants. And so it was typically, like pocket change, right, in the context of the overall capacity. But as capacity grew, and of course, the smart lawyers advising borrowers would look to every four corner of the document to try to find out whether there's capacity to do things. And J. Crew, like I said, was the first to really take advantage of the increase in capacity in unrestricted subsidiaries to use it for the purpose of priming the existing lenders. So move the IP out, borrow against the IP, send the cash back in, or conduct exchange offers or whatever. So it gives the borrowers lots more flexibility from that perspective.
Okay, and then I think effectively something similar seems to have happened in Altice. So there was a sort of March 21st management call where the management announced it would not contribute proceeds from assets back into the restricted group until it is well below 4 times net levered. So what seems to have happened there?
So what happened with Altice is that the assets that everyone sort of expected to be used for asset sales were moved out of the restricted group into an unrestricted subsidiary, which at that point, the borrower can do what they want with the proceeds of those asset sales. So that gave them the ability to use the position of those assets as leverage with the existing lenders to say, look, if you want to see these proceeds, you're probably going to have to take a haircut. So we're going to share the pain together. And I think one of the biggest surprises for the lenders is that there was so much capacity for Altice to be able to do that. I had been covering that covenant package basically since they issued their first bond. And I remember noticing in the builder basket, which I mentioned I went through before, that they had kept the start date of the builder basket, which is typically the first day of the fiscal quarter in which the issue date occurs. So for this one, it would be 1st of January, I think 2014. But they just kept referring back to original issue date, even long after those bonds that were the original issue date source were refinanced. So what you got was effectively 10 years worth of builder basket capacity under the 100% of EBITDA less 1.4 times interest expense formulation, which is an easier, quicker way to accumulate capacity over time. And the other point I will make about that is I mentioned those conditions, the 2 conditions that you have to follow before you can access builder capacity: no default or event of default, and meet the ratio test. Well, Altice didn't have to meet the ratio test to access their capacity. And of course, they wouldn't have been able to, because the ratio test is set at 4 times, and that's the target, sort of target leverage that they're talking about. So to make that investment in the unrestricted subsidiary, they didn't have to test the ratio, and they had 10 years worth of accumulated capacity to get the assets out there.
Got it. And so effectively what they're saying is, we will send those assets back into the restricted group, but and then I don't think we know what the but is, but it's like we are going to ask for liability management exercise measures for you to agree to, which presumably is some kind of reduction in the overall indebtedness.
Right. So it's sort of a different way of it's also using an unrestricted subsidiary for leverage, but it's the different use of the word leverage. It's negotiating
exactly.
rather than actual debt. And you know, who knows how the situation ultimately will play out, but it seems like a fairly effective move from the perspective of the covenants. It's permitted so far as I think most people, you know, can tell, and we'll just have to see how things progress.
Yeah. Well, I guess we need to sort of bring it to a close. I suppose the point about this is that covenants really do matter, and in some ways that there needs to be a bit of a counterparty to stop covenants, kind of the erosion that's been taking place. So you're sort of educating the market and hopefully fighting the good fight on behalf of the people who invest in these things. So I really wanted to say thank you very much. It's been a brilliant tour de force. It's sort of 40 odd minutes, and you've managed to sort of cover the entire structure. So really appreciate your time.
No, it's my pleasure. And I want to add that, you know, covenants are complicated, but they're not rocket science. And what the students who've graduated from Fox Legal Training have shown is that they can be learned. And I think that's what the market needs. The market needs lenders who've got credit analysis and covenant analysis skills in the same brain. So that's what we're trying to achieve. And, you know, that's, as you say, fighting the good fight.
Great. Well, thank you very much, Sabrina. And no doubt you will continue to fight the fight. Thank you.
Pleasure. Thank you.
You've been tuning in to the Turnaround podcast with your host, Stephen Phillips. You can find this show on all the major platforms, including YouTube, LinkedIn, Facebook, Apple Podcasts, Spotify, and on our website, frilibertas.com. Thank you for your positive reviews, comments, questions, and for sharing this show with others.